All right, Marty, thanks for joining me on a quickie podcast episode.
Diener, my pleasure, buddy.
So I thought we'd just dive right into it. And this is a very relevant topic off the top of my, or just currently, I'm going through incorporating my business. And we had spoke last week about while I was going through the incorporation process, I came across a section that I was like, oh, I'd never thought about this before. And that was shares and how to set up shares in a company. So I called you, you were very helpful. And I thought this is actually would be a great short, quick episode to talk about shares. So I was hoping we could just start by asking you about the difference between the two different types of shares that most companies, if you're like a one person or just like a small business that incorporates, what are the two different shares? And can you explain the difference between the two?
Yeah, I'll certainly do my best. I'm no lawyer, and a lawyer would be the one to consult if you actually want to know what's going on. But
Yes.
I can give my spin on it as I understand it.
Yes.
So typically, whenever you set up a new corp, regardless of how you do it, and it's not nearly as complicated as it's made to sound. So you usually have preferred shares, which are people call prefs, or common stock or common shares. You can also have non-voting shares as a third and separate class, but more often than not, you don't need it unless you're going to have a very complicated share structure or you're doing some sort of IPO or something. But if you're just a simple startup and you need to incorporate, keeping it simple and flexible would be my recommendation, as I kind of suggested to you, because that's what I did this time around, and it definitely helped.
Yeah.
So more often than not, you could set up A's, B's, and C's, and this only applies to Canada. I have no idea how it works in the States, but A shares, B shares, and C shares. Essentially, that just gives you the flexibility to pay different amounts of dividends to different shareholders or have different amounts of voting rights to different shareholders. The last piece would be if the corporation is ever dissolved, there's the assets of the corporation would be dissolved to the certain share classes as well, right? And that's usually not prefs. So let's say you're setting up A's and B's in your corp when you incorporate, and it's really just paperwork when you do your articles of incorporation. It doesn't cost more to have multiple share classes, but keeping it simple would be what you'd want to do. So you could have, let's say you set up A's and B's, and you have A common and A preferred, B common, B preferred. Common is your voting. Preferred is probably where you dividend, but you can also just have one class of shares entirely if you choose, which would just be your A common stock. So you can issue an unlimited number of those shares, but generally starting with a number like 100, I think makes a lot of sense, because now you have the option, if you ever wanted to sell equity in your company, you could either reissue new shares, and all you have to do for that is just say that the share class is the number you're allowed to issue is unlimited. So now Dean has 100 A shares of Dean Company, Dean Co. Inc.
Yeah.
And if I want to own half of Dean's company because he's printing so much money and I just need a piece of the action,
Yeah.
Let's say I wanted half, we have the option to either issue 100 of those same shares from the company, or he could sell me 50 of the 100 shares that he owns. The big distinction there is just tax treatment, ultimately, because if you want to dispose of your shares, let's say you purchase those shares in the company for $1 each when you set up the corp. You've worked so hard, your company is now worth $1 million or $10 million, let's say, and I want to buy half, so I have to cut you a check for $5 million, which isn't a big deal, right? It's Wednesday. And so now you get to use your capital gains exemption when you dispose of your shares to me. So if the corp just gives me 100 shares, you don't get to sell your shares. But let's say you want to dispose of half your shares. I buy them for $5 million. You bought them for virtually nothing. So the capital gains exemption in Canada at the time of recording, being 2020, is about 800K, give or take, per person. So now you would get to use your $800,000 capital gains exemption. So you would get $800,000 of ultimately tax-free earnings. It's a lifetime capital gains exemption. You only can do it once. But that's why I say keeping it flexible at the start is wise. Now, suppose is this where you want to go with this?
Mm-hmm.
Mind if I keep rambling?
Yep, keep going. This is beautiful.
Excellent.
This is good stuff.
Yeah. Well, let's hope it's right. Somebody fact check this shit before you publish. So then let's say you, in our agreement, I'm going to own half of the A shares with you, because we're going to have half and half voting. That's the common stock. So common stock is the voting. I control half, you control half. It's a stalemate, basically. It's actually not a structure I would ever recommend, but
50-50.
It is common. And for the sake of argument, this is what it is.
Yeah.
So now it's I'm going to have to work in the company now because you just exited and you took all your money. You're going to go chill on an island somewhere. So it's I'm going to get paid in dividends, and you still want to be able to draw some dividends, but I'm going to be able to draw more dividends than you because I'm working in the corp. That's just what we decided in our agreement. So what we would also probably do is just issue, say, A prefs or B prefs, let's say preferred shares, and each take a different amount of them, or sorry, the same amount, but of the different class. So let's say I take 100 of the Bs, you keep 100 of the As for preferred shares. So now we have two different dividending class. That's useful because when we declare dividends and pay ourselves out of the company, we don't have to dividend equally, which we would have to do if we only had one class of preferred shares, or even just the common stock. If we only had that and we dividend out, if I have half and you have half, every dollar that's dividended out of the company has to go in equal proportions to the shareholders within that class. Mm-hmm. So the Bs, I could cut a dividend check to myself for $5,000, and we're completely within the law by not, if we don't have to dividend you anything. Similarly, you can draw a bunch of money out of the As and not have to worry about paying me. So it allows you flexibility there.
Yeah. And I know when I set up my incorporation, I asked you, well, how many shares should I issue and what should the price be? And you pointed out something that's very good, and I double checked it on Dr. Google.
That's smart. That's what's smart. Yeah, double checking it. Whatever comes out of my mouth is wise.
And that was, in the beginning, it doesn't matter what you put the value on the shares, because it's not like, so for example, I think I did 100 shares at 10 cents each. So it was $10 in total. But down the road, if I wanted to sell those shares, they could be they could be worth more than 10 cents, ideally.
Yeah, exactly. The value is going to diverge.
Yeah.
Right. And then the difference between the 5 million that I have to pay, and if I'm, again, so let's stick with that theoretical transaction where if I buy from you, that nominal amount doesn't really matter. It isn't so important on the corporation side, right? Because I'm not actually putting any money into the corporation if I'm paying them to you. Suppose we want to do the other way. You decide you want to keep your lifetime capital gains exemption. So you're going to save that for later. And I am going to take 100 shares from the treasury, from the company, right? So you have 100 Class A common stock. There's no other shares issued. Now we issue me 100 Class A common stock. Whatever the number that we decide is the market value of those shares, the nominal value could stay the same. So I could pay the $10 for the nominal value of the shares, but then I also owe, $10 less than 5 million for the real value. And that goes into just an account on your books called paid up capital.
Mm-hmm. And you actually gave a really good analogy too, when because I was just learning all these terms. And I'm like, oh, like you can kind of get lost in the law jargon of it. And you gave a good bean analogy. Do you remember what you said?
Oh, you have to, you tell me.
I think it was like it's not as complicated as you think. I think it's like think of the 100 shares or whatever as like
Yeah,
a
sure.
100 beans, and
Yeah,
you
if you have
and like
100 beans in a jar,
right,
right? Yeah,
yeah,
you could take 100 beans and put another 100 beans in the jar, or you can, right? You could give me half of your beans. But at the end of the day, like all of these terms are created, right? So accountants and lawyers have things to argue about, and also to protect everyone, right? Like someone could misinterpret how we understand beans, but thankfully there's we have 1,000 years of legal precedent to make sure no one misunderstands shares.
yes, exactly. But I like that analogy. It was simple for me to visualize 100 beans in a jar, and then if I wanted to sell 50 of those to you, and the value of beans increase as my company grows, that made it that was just a really simple analogy that I think for people that are not aware of setting up a business and they might get overwhelmed with all these different technical terms, there's a way to my attempt is to make them simple to understand. So
And it
um
really is, man. It really is
yeah,
simple. Like I think you used a process called what? What was the online service you used?
I used owner ownr.com,
Which you
and
recommend, right?
I would recommend them. And this isn't a sponsored post or anything. And I will put a note in the intro of this episode saying that we are not lawyers. This isn't
Yeah,
legal
this is not
advice.
legal advice. Fact check all of this shit for yourself. This
Yes.
is just my very rudimentary understanding of it.
Yeah.
Yeah,
And mine
we
is
said beans in a jar for God's sake.
yeah, exactly. But I think you need to
Yeah,
also make this stuff simple to understand. Like when you go into a bank and you talk to an advisor, they throw out a lot of terms at you. It's like,
yeah.
can
If you
we?
take 100 beans and you get 3 more beans a year, right, for letting them hold your 100 beans, yeah, a little easier than them
Exactly.
talking about APR and all their
Yeah.
GICs and some other acronym.
Yeah,
Yeah,
exactly. So that's kind of my attempt with shares in setting up a company. And this I believe this does not apply to a sole proprietorship. Is that correct? Or am I
entirely
wrong?
different. Yeah, and
Yeah,
same with a partnership.
right.
I have no experience with those, but legally they're different. Like the purpose of the corporation is that you're limiting your personal liability. So
Yes.
as you found out when we went on, we had to still be three. You had to at least occupy two of the officer positions. Is that right?
I think it was
Two or
3, and
three? Three maybe.
you can set up I think 5 positions. So for me, and before I go into this, I want to preface it with the reason why I decided to incorporate as opposed to doing a sole proprietorship is so that my personal assets are not a liability. They're not at risk. So when you incorporate, you protect your personal assets.
Precisely. Yeah, and
Yeah.
that doesn't happen with a limited liability partnership or a sole proprietorship. You still have unlimited um, with the sole. You still have unlimited personal liability. Um, Now I'm with the as a director of any corporation, you still have you still have you can't be negligent, right? You still have fiduciary duty to the corporation, but you can't be negligent either, right? So you're still going to be personally liable for 5 things. I believe it's 5: CPP, Canada Pension, right? EI, any employment earnings, GST and PST, right? So any taxes that you would have collected and not paid, and any corporate income tax. So GST, PST together, and then any corporate income tax that you owe. Directors are fully liable for those personally. Same thing if you're negligent, if you knowingly, make your staff right go up a ladder and you don't have insurance, and they put a ladder on top of a ladder and you force them to do it and you held a gun to their head, right? Or whatever negligence, you're still personally liable for that. It doesn't give you the carte blanche to be an asshole. It just means that if the corporation goes under, Dean doesn't lose his house or his wife's house or what have you, right? You don't have any personal financial liability if you did everything that a reasonable person would do, to save harm.
Yeah, that's a good point. Definitely. Yeah. And don't walk out the ladder if your boss tells you to do that.
Yeah, crash course.
Yeah.
You're looking
yeah.
at the time like you have a boat to get on.
Yes. Yeah, exactly.
Yeah.
Yeah, totally. Okay. Well, I think we'll wrap it up here. I think that's like enough new information for people to digest. And then maybe we could do a round two talking about other stuff, business related, new
I'd like
business
that.
owners that start up. I think there's a lot of this stuff that is not talked about, and you don't learn about it until you go through the process. So
And
I
that is
think
the best way to learn it. It really
for
is.
sure it is.
Yeah. But if you can help simplify things a bit to encourage people to do it, right? Because it really isn't that complicated. None of it is, right?
Yeah.
It's just selling things for more than you buy them, and making sure that you check the legal boxes required. And most of even the legal stuff, like even taxes, payroll slips, like all of the CRA and GST or PST, all that stuff is not nearly as complicated as the $500 bill you'd get from your accountant would make you think.
That's right. Yeah. Yeah. Well, yeah, there's
I'm a moron and I can do it.
You are not a moron. You know your stuff.
Yeah, I'm a moron and I can do it. I swear to God, you can too. There's pages on the internet. You just follow it.
Yeah, totally. Check. Oh yeah, and we'll just wrap it up there.
Cool, man.
That's great. So thank you for explaining the difference between those, and for sharing the bean analogy, because I appreciate that simple analogy. So thank you very much.
Thanks for always fun to chat, man. Have a great weekend.
Yeah, you too. Take care.
Yeah, see ya. Enjoy the lake.
Yeah, you bet. See ya.
Bye, Dean.